Alright, hey, what's up guys? Scott here again with a brand new video, and for this one here, we're going to focus on the inverted strangle adjustment, which of course is an adjustment on a regular short strangle position as basically a last ditch effort to save the trade with the purpose of collecting additional credit and also of course by keeping your risk or your deltas in check. And specifically here, we're going to focus on IWM because right now I do have an experimental short strangle position on this ETF, and I'll be walking you guys through the various adjustments to get to an inverted position, as well as discussing the risk profile of that position and all the pros and cons of doing that. Now, briefly here before we get started, make sure you guys watch until the end of the video because at that point, I've got a very cool limited time opportunity for you all where you can receive up to 10 free stocks, and each stock could be worth up to $2,500. And also, if any of you would like to join a very exclusive online community where you guys can really learn how to successfully trade options, then you can now join my options trading Discord. So make sure you guys check out the description of this video below because I do have links to a separate video all about the Discord that will discuss the main features and benefits, as well as a link to my sign up page that you can use to join, and you'll begin your 7-day free trial. And then lastly here, for anybody who is brand new to the channel, again, my name is Scott, and you can also find me on SKILLSHARE as well, where you can take my very detailed classes on options trading or stock market investing. And you'll also find some links to a few of my introductory courses in the description of this video as well. So be sure to check them out. And when you sign up for SKILLSHARE using any of those links, you'll get a full 1-month free trial. All right, guys, so now diving in here. And like I said, we're going to focus entirely on IWM because I do have a current strangle on this ETF right now. So with that said, we'll go over to the trade tab here and take a look at that position. And currently I'm short the 185 strike call option, which is still far out of the money. That's great. And also a short 154 strike put option, also very far out of the money still. So at the moment, this trade is totally fine, but if IWM does start to move in a large amount in one direction or the other, then at that point, I will begin making adjustments to this trade. And the most important thing to keep in mind about making these adjustments is the deltas on both of your contracts. So specifically, as you can see in this column right here, these are the deltas of all these different put options. And same thing over here on the call side, once again, deltas of all the different call options. And right now the delta on my call is 22, that's fine. And the delta on my put option is 15. Now briefly here, just to summarize what deltas are with options in case you're not aware, the delta of an option will tell you approximately how much the price of that contract will change for a $1 move in the price of, in this case, IWM. So for example, right now IWM is at around 172.5 bucks per share. And so if this ETF were to move up or down by $1, then the price of my put option here will change by about $15. And then in a similar fashion with the call option here, again, if IWM moves by $1, then the price of this call option will change by about $22. That's it. Now also take note though that the delta of all option contracts, calls and puts alike, will increase as the price of the underlying stock does get closer to your strike. Right, so currently my 185 strike call option only has a delta of 22, but as you can see for the 173 strike call option, which of course is much closer to the current price of IWM, this one has a delta of 50. So bottom line, that means the price of this contract will change by a lot more as IWM moves around than the price of this contract. And so that is where things can get dangerous on a short strangle like this, where it's basically a short naked option position. Because again, if this ETF does move a lot in one direction or the other, my deltas on the whole trade will begin to get skewed more and more and more in one direction. So for example, right now at least, if IWM goes higher by just $1, then on the call side of this strangle, I will lose about 22 bucks, right? Because the call option here is going to increase in price by around this amount, which is a bad thing for me as a seller of this contract. But at the same time, I will profit about $15 on the put option, right? Because the way put options are priced, as the stock climbs higher, put option prices will fall in value. And that's a good thing for me as a seller of this put option contract. So ultimately here, if I lose 22 bucks on the call option, but I profit 15 bucks on the put option, then the combined effect is I lose only $7, which obviously is very, very manageable. But like I was saying, if IWM begins to increase in price by a lot, and therefore causing the delta on my call option to increase as well by a lot, that means I'm going to lose more and more money on the call side at a faster and faster rate. because also on the put side here, as IWM climbs higher, the delta on my put option will decrease in value. So therefore the profits I'll make on the put side will decrease more and more and more. And ultimately here, that's what would make this strangle become very, very unbalanced on, in this case, the call side. And as IWM continued to push higher and higher and higher, I would simply lose more money at a faster and faster rate. So therefore, what I can do to counteract this, right? Basically, an adjustment I can make to slow down my losses if, again, IWM begins to move too much in one direction or the other, is I can basically roll in one of my contracts. So once more here, continuing with our example, let's say this ETF does increase in price all the way to my short call strike of 185. And therefore, at that time, the delta on my call option would be at around 50. It would more than double here. And then also the delta on my put option would fall to probably 7 or 6. So now obviously I would have way too much risk on the call side here. So again, what I could do in that case is buy back my initial put option here and then sell a new put option much closer to the new price of IWM with also a larger delta. So perhaps I roll my put option all the way to the 165 strike now, which if at this point IWM was around 185 bucks per share, then the delta of this put option might be around 20 or so. Right, so currently the delta is 32, but again, if this ETF does climb higher by a decent amount, the delta on this put option will drop further. So therefore, if we assume in our example here that again by this time the delta on this 165 put option is 20 and the delta on my call option here has increased to 50, well that means the combined delta on the entire strangle is 50 minus 20, which equals 30. Not too bad. So bottom line here is when I do manage a short strangle in this fashion, I do always try and keep my combined delta on the whole trade under 50. So basically, if the combined delta on the trade gets above 50, then at that point, I'll make an adjustment as I've shown you here by rolling in one side or the other. And then also one more additional benefit that comes with moving in one of your strikes like this is you will also collect more additional credit as well. And so of course, the main idea there is the more additional credit you can collect over the course of the trade, then naturally you'll have much more money to offset losses when you do finally exit the position. So for example, if you carry this trade all the way to expiration and perhaps one of your contracts expires in the money and you get assigned, and let's say you lose, I don't know, $1,000 on the assignment, but your total credit at that point is over $1,000, well, you're still going to walk away with some amount of profit. And so ultimately, that's where the inverted strangle adjustment comes into play, because if your deltas here continue to get out of whack and you have to make more adjustments and collect more credit, etc., then eventually, if you keep rolling down your call option and or rolling up your put option, at some point, these two contracts are going to cross and become inverted. Right, so currently with my position as is, it's right now a normal strangle, but if I do, for example, have to continually roll up my put option again and again and again, and then perhaps somewhere down the road, IWM takes a nosedive and therefore causes me to roll down my call option. Well, like I was saying, at some point, my strikes are going to cross and then the whole trade here will become inverted, where basically my new short call strike will be lower than my new short put strike. So perhaps at that point, my position would look something like this. In which case, as you can see with the delta on the call option, right now it's 68, and the delta on the put option is negative 54. So therefore, the combined delta here is 68 minus 54, which is only 14. So again, that's the first reason why you may want to go inverted in the first place, to keep your deltas here in check. And then also, of course, the second reason is whenever you do roll your contracts, either the put option or the call option, you will collect more and more credit each time you do this. And so now for the sake of making our example here a bit more concrete, let's go ahead and set up a basic sell order to sell these exact contracts right now so that we can basically get an estimate for how much total credit we will collect if we did eventually get to this position here. So now I'll right click on the call option here and then go to sell and strangle. And here we go. This is a sell order to sell one contract of the 165 strike call option, which you can see right here. And then also one contract of the 175 strike put option, which is right here. And as you can see right down here, if you were to make this as your initial trade, you would collect around $2,000 of credit. Now that being said, if we began this trade with a regular strangle, as I have done here, then eventually if we rolled to get to this new position, this inverted strangle, then at that point, our total collected credit would still be less than 2,000 bucks or so. It might be 1,700 bucks, it could be more, it could be less, but chances are it would not be this much. But like I said, for the sake of our example, to make things a bit more concrete, we're just going to assume that this here is actually our total collected credit at this point in the trade, after making many adjustments to our original regular short strangle. And so now, with that assumption in mind, I'm going to right click on this order here and go to Analyze Trade. And there we go. As you can see here, this is a payoff diagram that will show you where on the trade you would be profitable and where you would be not profitable. So below on the x-axis here, you're seeing a range of possible prices for IWM. And then on the y-axis here, this again will show you how profitable or not profitable you are based on where this ETF ends up by expiration. So that means in particular, we're going to focus on this blue line right here, because this one here is your payoff diagram by expiration. And the one in purple, this is your payoff diagram as of today. And so now as you can see on the chart here, you would actually be very profitable on this trade if IWM by expiration ended up anywhere between 165 bucks per share or 175 bucks per share, which are your two short strikes, right? 175 is your short put strike and 165 is your short call strike. And that's because anywhere in this range by expiration, you will get assigned actually on both contracts, right? IWM will be above your short call strike, so you'll get assigned on that contract, and this ETF will be below your put strike, so again, you'll get assigned on the put option as well. So therefore, I'll go ahead and pull up the calculator real quick here, and I'll show you how this is all going to work. So focusing first on the put side, right? If you get assigned on a short put option, you must purchase 100 shares of stock at the strike price at 175. And then also, if you get assigned on a short call option, you must sell 100 shares at the strike price. So again, if we buy at 175 and then have to sell at 165, that's a loss of 10 bucks per share times 100 shares. That's a total loss of $1,000. But of course, don't forget that in our example here, your total collected credit at this point is $1,941. So ultimately, if we add 1941, that means we still make a profit of 941 bucks. Awesome. And that's exactly what you can see here on the payoff diagram as well, right? Where anywhere in this zone, as you can see down here with this blue number, anywhere in that zone, you'll make exactly $941. Now that being said though, that is only the first possible scenario that could play out by the expiration date, right? Where this ETF ends up in between your two strikes. But now a second possibility is, what if IWM expires below your short call strike and your short put strike? Well, in this case here, your short call option is going to simply expire worthless and just disappear. But then you will still get assigned on the short put option with your 175 strike. So if, for example, let's say by expiration, this ETF ends up at around, call it 160 bucks per share, somewhere in this zone, then once more, we'll bring back the calculator real quick here. So same thing, if you do get assigned on the short put option, you'll have to buy 100 shares of stock at a price of 175. And then if we did not want to keep those shares, we could sell them at the market price, which in our example here was 160 bucks per share. So therefore that would be a loss of 15 bucks per share times 100 shares. That's a loss of 1,500 bucks. But again, in total, we have collected 1,941 bucks on the whole trade. And so in the end, we still make a profit of 441 bucks. Awesome. And you still will make a profit on this trade anywhere above a price of around $155.60 or so, right? So this small red tick right here, this is your break-even point on the downside. As long as IWM is above this price by expiration, you'll make some amount of money. And then finally here, the third scenario is, what if this ETF expires above both your short call strike and your short put strike? Well, in this case, your short put option is just going to expire worthless. It's just going to disappear, but then you will get assigned on your short call option with the 165 strike. And therefore, you'll be entered into a short stock position on 100 shares. So if, for example, by expiration, IWM ends up at, let's say 180 bucks per share, somewhere around here, then one last time, I'll bring back the calculator. So in this case, as I explained, you'll get assigned on the call option, which means you'll have to short 100 shares of stock at 165. And then if you wanted to close that short stock position, you'll have to buy the shares back at the market price, which in our example is 180 bucks per share. So once again, that's a loss of 15 bucks per share times 100 shares. So once more, you lose 1,500 bucks on the assignment, but once again, you still do get to keep the full credit on the trade, which is 1941, and therefore you still walk away with a profit of 441 once again. And same thing for the upside on this diagram. This small red tick right here is your break-even point, which comes in right around 185-ish bucks per share or so. So bottom line, if IWM is anywhere in between your strikes by expiration, you'll make the most amount of money. But also, if this ETF is anywhere above a price of 155 or below 185 bucks per share, anywhere in this range, you will still make some amount of profit. And then of course, anywhere outside of that range, either to the upside or the downside, you will begin to lose money. And so that is the inverted strangle adjustment. I hope everything made sense in this video, but of course, if it didn't, please feel free to post your questions or thoughts in the comment section below. And then lastly in this video, as I mentioned, I do have a very cool limited time opportunity for you all where you can receive up to 10 free stocks. So basically there is a newer brokerage company out there called Moomoo, which is based in Palo Alto, California. And again, for a limited time, they're offering you the opportunity to receive up to 10 free stocks when you open a brokerage account with them using my link in the description of this video. And so the Moomoo trading platform is highly competitive with other comparable platforms like Webull and Robinhood. There are absolutely no trading fees on stock or option trades. You also get direct trading access to US, Hong Kong, and Chinese markets, which is something I have not seen being offered by competing platforms. Moomoo also comes with a free, very advanced, yet totally user-friendly trading platform that you can install on your computer or your smartphone. And of course, everything is regulated by the SEC and FINRA, so your trades and your investments are properly insured. And so if that sounds good to you, then again, use my link in the description of this video to sign up and get your free stocks. And also don't forget to check out and sign up for my options trading Discord as well as my Skillshare courses. Links also in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week and you don't want to miss out. So thanks again for watching, and I'll see you next time.